Today we are discussing Gap Inc., ticker GPS. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, this company has a market cap of $4.7 billion, enterprise value of $5.9 billion. So you see about $1.2 billion in net debt on this business. That's pretty significant because that's about 20% of the overall enterprise value. This is operating in the specialty retail space, and we can see from this description they operate as an apparel retail company. So they offer apparel, so shirts, clothes, shoes, things like that, personal care products for men, women, and children under the Old Navy, Gap, Banana Republic, and Athleta brands. So those would be the brands that their stores are selling from and that sort of thing. So the denim, tees, fleece, khakis, eyewear, fitness and lifestyle products, yoga, training, sports travel, etc., etc. So they have both company operating stores, franchise stores, websites, everything like that. They also operate in Asia, Europe, and Latin America, in addition to the United States, 2,800 company-operated stores and 564 franchises. So one thing to take note of is anytime with apparel companies, they're usually very, very competitive, usually tend to be a relatively low-quality business. We do see that the beta here is 1.8. That's about 80% higher than your average S&P 500 stock. The higher the volatility tends to be relatively lower quality. However, we can instantly see from the return on invested capital chart that they are bucking the trends of their overall industry because their returns on invested capital are very, very good. You see only 1 year of losses in the last 20 years, and that, of course, seems like it is due to COVID, where they lost money in 2021. Other than 2021, they made money every single year for the last 20 years, which is a very good sign. That meets the first threshold for my high quality business, was hitting 19 out of 20 years with profits, and they are hitting that metric very well. Also, you see they spend a significant portion of their history with over 20% returns on invested capital, which is a relatively rare phenomenon and is usually a marker of a high quality business. So again, another marker of a high quality business. In fact, I believe they only have 4 years in the last 20 years where they're below a 10% return on invested capital. And that's the mark I'm usually looking for, is managing to be above 10% return on invested capital. But in fact, they spend a significant portion of their time with over a 15% return on invested capital. And we can clearly see over the last 10 years, they've averaged a 20% return on invested capital. These are phenomenal numbers and is instantly putting it into that high quality business category. And of course, again, we said there was that $1.2 billion in net debt. And so when you add $1.2 billion in net debt onto return on invested capital of 20%, you get something really interesting like this 29% return on equity. All of these numbers are really good. Your return on invested capital of 20 is twice my target of 10%. Return on equity of 29% is twice my target of 15%. So this is definitely in the bucket of a high quality business. Now, when you get to PE, you see 86. And your first thought is like, oh, that is super expensive. But immediately I see the price to sales of 0.3, and I start to wonder if this PE is accurate. And I'm going to guess it's not, because the price to book, the price to sales, the EV to sales are all showing a relatively inexpensive company. And so we need to understand what this discrepancy is. Are the earnings off on a one-time basis? And that's what we're going to do through the rest of this video. Now, the 10-year CAGR in growth is a little disappointing. 1.4% revenue is very little growth. It's basically flat, but it is slightly growing, and you do see the asset growth of 5.6%. The fact that your assets growing so much faster than your revenue is why your returns today are worse than 10 years ago when they're up closer to 20%. Now, of course, the last 3 years have been particularly hard, so I don't know how much you'd want to judge this on, because clearly COVID had a major impact when things were shutting down and everything along those lines, but it does show your EPS has declined as well. Anytime you see a negative 8% EPS, you're seeing your earnings are declining by 50% over the course of a decade. That's a significant drop. And so what's going to become important for analyzing this company is, are the returns of this portion of its history still relevant, or is it a new business post-COVID? And that's going to be harder to tell with these numbers, but we're going to see what we can find out. Now, you can see that although they lost money in COVID, they had a positive gross profit every single year. They had a positive operating profit every year except that COVID year where they lost money. So what happened? I mean, you saw that they had operating profit of $574 million in 2020, but they had a significant drop in their revenue. 15% drop in their revenue basically wiped out all of their operating profits, sent them into that loss, but they solidly recovered once things opened back up. So I'm not super concerned about this loss. This does seem like a black swan type event for a business like this. It's not common that you just shut down everything. So I'm not super concerned about this year in particular. You can also see that they quickly restore their dividends. So the business managers are also not concerned about that overall. So when I look at this, though, I see this strong period from 2013 to 2019 operating in this $2 in earnings per share range. Pretty reliably earning that. You did have a poor year in 2017, but overall you're in that $2 in earnings per share range. But the last 3 years have been substantially worse. You lost money in 1 year, made it in both of the other years. The question becomes 0.67 here is, of course, how you're getting these outrageously high PE ratios is you have these poor recent numbers. But if you think, okay, well, maybe their true earnings power is still $2 a share, and in that case, you're thinking that maybe this company has more of a 6 times PE. And if that's the case, the company becomes very, very attractive because a PE of 6 is a very cheap price for a business with these types of returns on invested capital. So, is the future going to be like the historic past, or is the future going to be like COVID? That's the key question for this business if you want to own some shares. Because otherwise, everything here looks good from return on invested capital. Everything looks good here in terms on you have a dividend payer, you have high returns, and you're able to operate in a relatively difficult marketplace. So good to know there. If you're enjoying what you're hearing so far, hit that like button. And by the end of this video, I'm going to try and convince you to become a subscriber for this channel because I work through every company in the S&P 500. So let's go to the income statement. One thing you can see here is that when you look at 2021, one of their big problems is that their cost of goods sold did not fall as fast as their revenue. And that allowed them to have a pretty big drop in gross profit, which really hurt because they were unable to shed any of their other operating expenses. That overhead cost really killed them, and that's why they lost money in that year. But a big positive sign that I see on the income statement is this shares outstanding. You can see that they've declined in shares outstanding from 488 million down to 383 million. So they've basically wiped out 100 million shares. That's approximately 20%, 20 to 25% of their shares over the course of a 10-year period. You're adding about 2% a year to your overall returns because of that EPS. Because you've wiped out that many shares. And you can see the big concern here is, of course, how do you get this 86 PE? It's because your trailing 12-month numbers are reporting 16 cents in earnings per share. You multiply that out, it's going to look very, very terrible. So again, is this recent history what the future is going to look like? If that's the case, it's not really investable at this price. If you can get back to pre-COVID numbers, it could be a gangbusters investment. You could be really excited about your return. That's the underlying question still after the income statement. Balance sheet. Let's look at PP&E. You see your PP&E's actually declined over the last few years. Well, but there was a big jump in 2020. So was there an acquisition? Did they make a big acquisition? Because your liabilities jumped. Oh, okay. Wait. So you have capital leases as a liability. And they also had a big jump in their PP&E. So I think this is probably a tax effect, changes in how you have to take into account leases. And so they probably took on a new asset here, which is their rental asset and the capital lease kind of offsetting each other. That makes sense. It doesn't necessarily look acquisition-wise. This is a big problem for retail companies is a lot of their asset liability numbers have gotten massively distorted with the changes in the GAAP earnings reporting standards. So some of this asset return basis looks worse than it otherwise would. It also explains a big reason for this big drop despite having, probably similar economics, all because of that. But otherwise, your debt plus your capital leases, here's, $6.5 billion in PP&E. Those match up really well, so I don't really have concerns about their debt usage. That looks pretty normal for a business like this. Let's go to cash flow statement. So one thing that's encouraging is although they lost money on a GAAP basis in 2021, they were positive cash flow. Anytime you can maintain positive cash flow is again another sign of a quality business. They were able to do that through that period, which is a good sign. You can also see, of course, they didn't have an acquisition. So I am right. I think that it was an accounting issue in 2020. The way that those accounting rules changed kind of affected what we're seeing here. It's not a true change in the underlying business. It's just the way they're having to report leases now on the balance sheet itself instead of being an off balance sheet item. let's see. You can see these pretty steady buybacks. They didn't do buybacks in 2021 when they struggled. They didn't do buybacks in 2017, but they do have pretty steady buybacks over time. That's good because they are paying stock-based compensation. I don't like seeing stock-based compensation in a lot of companies, but it is important that even in these early years where they had stock-based compensation, they were doing buybacks about 10 times bigger than that, which is allowing them to still retire shares. Same thing here that, they tripled their stock-based compensation with their buybacks, and that's kind of offsetting dilution. It's preventing further dilution, but it does show you don't have steady buybacks every year. Some of this volatility of the business. It does look like when they're doing well, you get good buybacks, and when they're not doing well, you don't. So that's also okay because they're working it within their threshold. One thing you can see here is all the depreciation numbers in the 500 million, and most of your PP&E expenses are in the 600 or 700 million range. And so you're seeing that it's kind of like a little bit higher over time. That's kind of leading to that steady kind of growth in your PP&E over time. Not anything significant, but it kind of runs in range. They're not massively out of range, mark with each other. So that's good as well. I like that I see some debt pay downs. That's always a good sign. This is almost like a risk reduction, it looks like, post-COVID. And of course, they're pretty steady with their dividend payments. The big difference was, of course, with COVID having to stop. So overall, I think Gap is really interesting business. What's really interesting about Gap is this is clearly a high-quality business. Straight up, very strong returns. There's no cyclicality here. It's pretty stable year to year. You do have a little bit of bouncing around here, but I'm not concerned about that. That's not these big cycles that can really tank a business. COVID is clearly an exception to how this business had to go through. I wouldn't expect a lot of COVID-like repeats in the future, so I'm not super concerned about those numbers. Also, the big drop in return on invested capital is clearly associated with the change in reporting standards in terms of what goes onto the balance sheet. It's not a big change in the underlying business quality. So again, that's not a big concern for me as well. I see a high quality business here. The price is actually very, very interesting if you think that the true earnings power here is $2 a share. I can't make that determination in this short 10 to 15 minute video because what I need to do to determine that is really dive into the 10K, dive into what the company management is saying on some of their conference calls to really help me understand the tenor of the business, both through COVID and after COVID, to see if we're going to get back to those sorts of numbers. If you are, this could be a very, very attractive price into a very attractive business. And that's despite the revenue growth being relatively slow. 1% revenue growth plus like a 2% buyback gives you like 3% growth, and you put that on a PE of 6, and you can still get really attractive double-digit returns, in that 10 to 15% range pretty easily with that sort of setup. The big problem is what is the true earnings power, and where is that going to go? Otherwise, the price could be very attractive. Does it go on my watch list? And for me, the answer is no, and it's solely because of revenue growth. I really like to see companies with bigger revenue growth. Single digits on its own is not a deal breaker, but high single digits is really what I want to see if it is single digits. Of course, I always want double-digit growth, but I'm okay with single-digit revenue. This is just a little low for me. It's basically flat revenue, and when you have flat revenue, it just means management has a harder time competing in the marketplace. So although it's a very good business, they have high-quality assets, it looks like it's being managed pretty well. It's not going to go on my watch list for that reason. I just really want higher growth. However, I do think it's a very interesting opportunity in the market today. If the PE is closer to something like 6 or 7, that could be in a very attractive price. But of course, you're going to have to do that extra work, dive into the 10K, and understand where does their earnings power stand. Is it closer to 50 cents, $1, $2, or $3? And that's going to drive the purchase decision. So thank you for listening, and don't forget to like and subscribe. And if you enjoy this type of content, if you want to see the companies that did make my watch list, hit that playlist up above. That's all the companies that made my watch list in the S&P 500. I think it's worth checking those out. If you want to use the software that I'm using to study companies, it is quickfs.net. My affiliate link is the first description in the below. Please consider using that link. Won't cost you anything extra. You can get a free or paid account through that link. Thank you for listening. Until next time, stop paying fees, start building wealth.